While the world was watching Bitcoin blast back above $90,000, something massive was happening in the shadows. On the 3rd of December, while we were distracted by the price of the orange coin, Ethereum quietly executed one of the most important upgrades in its history. They call it Fusaka. And unlike the hype-fueled promises of the last cycle, this isn't just a roadmap update. It's live, it's running, and it fundamentally changes the economics of the second largest cryptocurrency on the planet. For months, Ethereum has been the punching bag of the industry. It's been called slow, expensive, outdated. The Solana killer narrative has been flipping to an Ethereum is dead narrative. But what if the sleeping giant just woke up? What if the smart money, the institutional giants like BlackRock and Fidelity, are quietly rotating their profits while retail investors are looking the other way? We're seeing signals that the bottom might finally be in. Futures volume on the CME has flipped, staking ETFs are back on the table, and the tech just got a turbocharge that could finally fix the one thing holding Ethereum back. Is this the moment the narrative shifts, or is it too little, too late? Today, we're breaking down the Fusaka upgrade, the institutional rotation that no one is talking about, and the price targets that could melt faces in 2026. My name is Guy, and this is the Coin Bureau. Now, before we dive into the code and the capital flows, I need to remind you that I am not a financial advisor. I'm just a guy on the internet who spends way too much time reading Ethereum improvement proposals, so you don't have to. This video is for educational and entertainment purposes only. And if you want to see Ethereum wake up and choose violence against the bears, then prove it by smashing that like button until it gasps for air. Okay, let's start with the upgrade itself, because if you blinked yesterday, you probably missed it. The upgrade is officially called Fusaka, and yes, that sounds like some type of sushi, but it's actually a portmanteau word combining Fulu for the consensus layer and Osaka for the execution layer. Just go with it and don't let the naming convention intimidate you, because what's under the hood is actually kind of terrifying, in a good way. This upgrade activated at slot 13,164,544, and it included about a dozen Ethereum improvement proposals, or EIPs. But there is one feature that matters more than anything else. It's called Peer DAS. This stands for Peer Data Availability Sampling. And yes, data availability sampling sounds like a cure for insomnia, but this is the holy grail of scaling. Vitalik Buterin has been talking about sharding since 2015. Now, sharding is the idea that you don't need every single computer on the network to do all the work all the time. If you can split the work up, you can go faster. Well, Vitalik tweeted on Wednesday that sharding is finally here. Peer DAS allows validators to verify that data is available by checking only small slices of that data rather than downloading the entire blob. Think of it like this. Before Fusaka, if you were a validator, you had to download the entire book to prove it existed. Now you just need to read a few random sentences from a few random pages to prove the book is there. This reduces the amount of data a node needs to download by approximately 87.5%. That's an 8x efficiency gain overnight. But why does this matter to you? Well, because it allows the network to process massive amounts of data from layer 2 networks without clogging up the main chain. It's the difference between trying to drink a milkshake through a coffee stirrer and drinking it through a fire hose. And this brings us to the second major part of the upgrade, the Blob Parameter Only forks, or BPO for short. The developers didn't just turn the dial to 11 on day one, they're rolling out capacity increases in stages. The first BPO fork hits on the 9th of December and the second on the 7th of January. And these forks are going to gradually increase the number of blobs per block. Before Fusaka, the target was 3 blobs per block. By January, we're looking at a target of 14 blobs with a maximum of 21. This is a massive increase in supply for data space. And basic economics tells us that when supply goes up, price comes down. Analysts are projecting that layer 2 fees, the fees you pay on Arbitrum, Base, or Optimism or whatever, could drop by another 40% to 95%. We're talking about sub-cent transactions becoming the norm, not the exception. And this solves the biggest criticism of Ethereum, that it's too expensive for regular people to use. But there's a catch, and it's a big one. If fees drop, doesn't that mean ETH becomes inflationary again? If we aren't burning ETH through high gas fees, doesn't the ultrasound money narrative die? Well, Fusaka includes a clever little fix for that too. It's called EIP 7918, and this establishes a minimum price or a floor for these blobs. Before this, L2s were basically getting a free ride when the network wasn't congested. They paid pennies. Now there is a reserve price. Bitwise Asset Management noted that this strengthens Ethereum's value capture mechanism. It ensures that as Layer 2s scale and process millions of transactions, Ethereum, the asset, still captures value from that activity. It aligns the incentives of the L2s with the L1 holders. So, technically speaking, the ship has been upgraded. The engine is brand new. But does anyone actually care? Because, let's be honest, technology doesn't always drive price. Markets run on narratives and liquidity. And for the last year, the narrative for Ethereum has been terrible. But if you look at the institutional data, specifically the derivatives market, something strange is happening. The institutions are quietly positioning themselves. And before we get into the massive signal flashing on the CME, I want to quickly talk about how you can position yourself. Because while the institutions are buying futures contracts, you have the advantage of being nimble. If you're looking to trade this potential Ethereum reversal, or if you just want to stack more ETH before the crowd wakes up, you need a reliable exchange. And that's where the Coin Bureau deals page comes in. We have curated the absolute best sign-up bonuses, fee discounts, and exclusive offers from the top exchanges in the industry. We're talking about deposit bonuses that can go up to $100,000 for high-volume traders. We have trading fee discounts of up to 50%, which is massive if you are active in this volatility. And we have deposit cashbacks of up to 75%. Whether you're a seasoned trader looking for better liquidity or a newcomer just setting up your first account, these deals are designed to give you a head start. The institutions are getting their deals behind closed doors. This is how you get yours. So hit the link in the description below or scan the QR code on the screen right now. It helps support the channel and put some extra crypto in your pocket. These offers rotate regularly though, so make sure you take advantage of them while they last. Okay, back to that institutional signal. And this one is a biggie. We're talking about the flippening. No, not market cap, calm down ETH maxis. We're talking about futures volume on the Chicago Mercantile Exchange, or CME. For the first time in history, Ethereum futures volume on the CME has flipped Bitcoin futures volume. This happened in early December, just as the Fusaka upgrade was going live. Now, why does this matter? Well, the CME is where the big boys play. This isn't retail traders on Binance using 100x leverage on Popcat. This is hedge funds, asset managers, corporate treasuries. When volume spikes on the CME, it means institutions are active. And the fact that they are trading more ETH than BTC right now tells us that they are rotating. They're hedging, they're speculating, they're positioning. Priyanka Jain, a director at CME Group, noted that Ether options are actually exhibiting higher volatility than Bitcoin options right now, over 60% implied volatility. Now, usually institutions hate volatility, but in crypto, they love it. Volatility means opportunity. It means the price is about to move, and they want to be there when it does. And this rotation is classic market cycle behavior. Bitcoin leads the charge. It breaks the all-time high. It sucks in all the liquidity. Then, as Bitcoin consolidates, that capital looks for the next play. It looks for the asset that hasn't run yet. It looks for the beta. And right now, Ethereum is the ultimate value play for these guys. But it's not just about trading volume. There is a structural catalyst coming that could change everything. I'm talking about the killer app for institutions: staking ETFs. Now, remember when the Ethereum spot ETFs launched? They were kind of a dud. I mean, they did okay, but they were missing the most important feature of Ethereum, the yield. Buying ETH without staking it is like buying a dividend stock that doesn't pay the dividend. It doesn't make sense for a sophisticated investor. But the winds in Washington, D.C. are changing. With a new administration and a revamped SEC, the regulatory blockade against staking is crumbling. In September 2025, we saw the first crack in the dam. Rex Shares and Osprey Funds launched the first US Ethereum staking ETF strategy. It's a complex structure, but it exists. And now the big guns are lining up. BlackRock, Fidelity, Grayscale. They all have applications pending or are preparing to amend their filings to include staking. Just think about what this means for a pension fund or a family office. Right now, they can buy a treasury bond and get maybe 4 or 5%. Or they could buy a staked ETH ETF. If approved, they get the potential capital appreciation of the tech sector plus a native yield of 3 to 4%. It turns Ethereum into a productive asset. It becomes a digital bond. Bitwise CIO Matt Hogan has said that staking is the, quote, killer app that will differentiate Ethereum from Bitcoin in the eyes of institutional allocators. Bitcoin is digital gold. It sits in a vault. It does nothing. Ethereum is digital real estate. It generates rent. If staking gets approved for these major ETFs in 2026, we could see a wall of money that makes the initial ETF launch look like a dress rehearsal. So, the tech is upgraded, the institutions are interested, the yield is coming. What does the chart say, though? Because if you look at the ETH-BTC ratio, it has been ugly. We've been in a brutal downtrend against Bitcoin for over 2 years. The ratio hit a multi-year low of around 0.032 recently. For Ethereum holders, it's been painful. You've watched Solana pump, you've watched Bitcoin pump, and ETH has, by and large, just crabbed. But extreme pain usually precedes a reversal. Technically, we're sitting at a massive historical support level. This 0.03 level goes back to the bear market of 2019 to 2020. If this level holds, and we're seeing signs that it is, the rotation could be violent. We're seeing a falling wedge pattern, which is typically bullish. We're seeing the RSI on the weekly timeframe flashing oversold divergence. And we're seeing whales accumulate. On-chain data shows that whales bought over $1.3 billion worth of ETH during the dip in November. They aren't selling, they're buying your panic. So, where could ETH's price go? Well, Standard Chartered, who by the way have been surprisingly accurate with their Bitcoin calls, recently updated their ETH targets. Back in March, they were bearish. They cut their target to $4,000. But in August, they revised that drastically. Jeff Kendrick, their head of crypto research, raised his year-end 2025 target to $7,500. And his target for 2028, $25,000 per ETH. Van Eck is bullish too. Their base case for 2030 is $22,000 per coin. That represents a roughly 600% upside from where we're sitting today. Now, why are they so bullish? Well, it comes down to cash flow. Van Eck predicts that Ethereum will continue to dominate the high-value sectors of crypto: DeFi, stablecoins, and tokenized assets. And speaking of dominance, we have to address the elephant in the room, or rather, the cheetah in the room, Solana. You cannot talk about Ethereum in 2025 without talking about Solana. The narrative war has been intense, and rightfully so. Solana is faster, cheaper, and the user experience is arguably better for the average retail user. Compare what it's like using Phantom to using MetaMask. Solana has been flipping Ethereum in daily DEX volume regularly. It has more daily active users, and this is a real threat. As one analyst put it, quote, Ethereum is like a shark. It must keep moving or it will die. If Ethereum cannot scale, if the Fusaka upgrade doesn't lower fees enough, Solana will continue to eat its lunch. However, there is a nuance here that the ETH is dead crowd misses. Total value locked. Ethereum still has over $100 billion in TVL. Solana has around $13 billion. Ethereum has $85 billion in stablecoins. Solana has around $4 billion. The big money, the safe money, is still on Ethereum. Why? Security and decentralization. When BlackRock tokenized their money market fund, BUIDL, where did they launch it? Ethereum. When Visa settles stablecoin transactions, where are they doing it? Ethereum. Institutions value uptime and security over speed and cheap fees. They don't care if a transaction costs 1 cent or 50 cents. They care that the network won't go down. So, while Solana might still win the retail casino, Ethereum is positioning itself to be the settlement layer for the global financial system. It's Apple versus Android, or maybe New York City versus Las Vegas. Both can exist. Both can thrive, but they're playing different games. However, it's not all sunshine and rainbows. We have to talk about the risks. Because even with Fusaka, even with the ETFs, there are massive headwinds as we roll into 2026. First, there's the fragmentation problem. We've solved scaling by creating layer 2s, but now we have a user experience nightmare. You have assets on Arbitrum, but you want to use an app on Optimism. You have to bridge, you have to wait, you have to pay fees. It's clunky. It feels like the early internet where you couldn't email someone on a different provider. Vitalik knows this, and the developers know this. They're working on based rollups and interoperability standards, but until that is fixed, the user experience is going to lag behind Solana's monolithic design. Then there's the macro environment. We have a Federal Reserve meeting coming up on the 10th of December. We have recession fears lingering. We have a 10-year Treasury yield that refuses to go down. If the traditional economy sneezes, crypto catches a cold. And Ethereum, with its high correlation to tech stocks, often gets hit the hardest. And finally, there's the regulatory risk. Yes, the SEC is changing, but the Prometheum issue and the classification of staking rewards are still legal grey areas. If the IRS decides to tax staking rewards in a punitive way, or if the SEC demands strict KYC for validators, it could crush the staking economy. So, where does that leave us? Is Ethereum a dying dinosaur or a sleeping giant? Okay, well, here's the verdict. Ethereum has been hated, it's been shorted, it's been ignored. The price action has been boring. But while the price was boring, the fundamentals were compounding. Supply is shrinking, yield is real. Scaling is finally here with Fusaka. And the institutions are noticing. They're flipping their futures positions. They're filing for staking ETFs, and they're looking at that 0.03 ETH BTC ratio and seeing a generational buying opportunity. Ethereum is still the highest quality, most decentralized, most economically robust smart contract platform on Earth. So, don't count it out. But what do you think? Is Fusaka enough to save Ethereum, or is Solana going to flip it in 2026? Give us your hottest takes in the comments below. And if you want to know more about which layer 2s are going to benefit the most from this upgrade, then you should check out the video right over here. Okay, thanks all for watching, and I'll see you in the next one. This is Guy, signing off.